Hey guys, welcome back to my channel Unlock the Locked by Ashay. Please don't forget to like, subscribe, comment, and share this video to the max you can. IFRS 16 Leases introduces a new model of accounting for lease contracts that will have a huge effect, particularly for leases. Today, we will be going through the following topics in this video along with the accounting treatment. First, being the background to understand the emergence of IFRS 16. Then, the objective to answer the why of IFRS 16. Applicability, thereby looking at the exception or exemption of IFRS, followed by what is a lease, what exactly lease means. Then, its accounting in the books of lessor and lessee, sale and leaseback transaction, and finally, the most important and the latest amendment on account of COVID 19. So, to begin with, the past standard IAS 17 does not apply anymore and IFRS 16 stands applicable effective 1st Jan 2019. The basic objective of IFRS 16 is to specify the rules for recognition, measurement, presentation and disclosure of leases by both lessor and lessee. Over here, I would really like to highlight one of the main objectives of replacing IAS 17 with IFRS 16. And it is that under IAS 17, lessee was still able to hide certain liabilities resulting from leases and simply not present them on the face of financial statements. And when I talk about leases over here, I am referring to operating lease, especially those with non-cancelable terms. However, under the new standard, lessee will need to show all the lease right in their statement of financial position instead of hiding them in the notes to financial statement. And that is also one of the main objective of coming into being of IFRS 16. So now, before we move on to understand lease, let us have a quick look at the items which fall under the exclusion category. IFRS 16 does not apply to lease right for mines and exploration, lease of biological assets, intellectual property licenses, service concession agreements, rights under licensing agreements. Besides, there are two optional exemptions as well. First being for lease with term of less than 12 months and second is lease of low value item. For this, you can simply account for all payments on SLM or any other systematic basis. Now let's understand what is a lease. A contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for a consideration. Besides, one has to carefully assess various other elements like can the asset be identified, can the customer decide about the asset's use, can the supplier substitute the asset during the period of use, and so on. Also, one need to understand how to separate lease and non-lease components in the contract. So now we'll be getting to the accounting part of lease, and in that let's touch upon accounting of lease by lessee. So over here, one of the big change in IFRS 16 in comparison to older IAS 17 is lessee don't classify lease into operating and finance lease. So there is no classification at all. Instead, lessee account for all the leases in the same way. So at the time of commencement, a lessee account for two elements. First being right of use of asset and second lease liability. In case of right of use of asset, it shall be equal to the lease liability, which then gets adjusted with say lease payments made before or on commencement date, less lease incentives received if any, initial direct cost and any estimate of dismantling and restoration cost. With respect to lease liability, the lease liability is in fact all payments not paid at the commencement date discounted to present value using the interest rate implicit in the lease or the incremental borrowing rate. But what are these payments? These payments they can include say fixed payments, variable payments, residual value guarantees, exercise price of purchase option, penalties for terminating the lease and so on. After commencement date, lessee needs to take care about both elements recognized initially. those were right of use of asset and lease liability. So in case of right of use of asset, normally a lessee needs to measure the right using a cost model. However, lessee can also apply fair value model or revaluation model. But under the cost model, the entry to be posted is debiting the depreciation expense in P&L and crediting the right of use of asset accumulated depreciation account to depreciate the asset over the lease term. In case of lease liability, there are two things to be taken note of. Firstly, a lessee needs to recognize an interest on the lease liability by debiting interest expense in P&L and crediting lease liability. And secondly, the lease payments are recognized as a reduction of the lease liability and hence debit lease liability and credit cash and bank. If there's a change in the lease term, lease payments, discount rate or anything else, then the lease liability must be remeasured to reflect all the changes. So now let's look at the accounting of lease by lessor. So nothing much has been changed in accounting for lease by lessor. So lessor need to classify the lease first before they start accounting. So in terms of classification, there are two types of leases defined in IFRS 16. First being finance lease and second being the operating lease. So finance lease is a lease that transfers substantially all the risk and rewards incidental to ownership of an underlying asset, and an operating lease is a lease other than a finance lease. In IFRS 16, it outlines 5 situations that would normally lead to a lease being classified as a finance lease. First being, the lease transfers ownership of the asset to the lessee by the end of the lease term. Second, the lessee has the option to purchase the asset at a price that is expected to be sufficiently lower than the fair value at that time, and at the inception of the lease, it's almost sure that the option will be exercised. Third being, the lease term is for the major part of the economic life of the asset, even if the title is not transferred. Fourth, at the inception of the lease, the present value of the lease payments amounts to at least substantially all of the fair value of the leased asset. And the fifth part is the leased assets are of such a specialized nature that only the lessee can use them without major modifications. Over here, fulfillment of any of this situation will result into a finance lease. So now let's look at how lessor will account finance lease. At the commencement of the lease term, lessor should recognize lease receivable in his statement of financial position. The amount of receivable should be equal to the net investment in the lease. And what is that? Net investment in the lease equals to payments not paid at the commencement date discounted to present value plus the initial direct cost. And this is exactly the same as described in lessee's accounting. So the general entry over here is debiting the lease receivable and crediting the underlying asset. Moving on to the subsequent measurement. Once the initial thing gets done, what happens when the subsequent measurement takes place? So the lessor should recognize reduction of lease receivable and finance income on the same, for which the general entry would be debiting the cash in bank and crediting the finance income in P&L. Finance income shall be recognized based on the pattern reflecting the constant periodic rate of return on the lessor's net investment in the lease. Now, let's look at the accounting for operating lease by lessor. Lessor keeps recognizing the leased asset in his statement of financial position. So lease income from operating lease shall be recognized as an income on a straight line basis over the lease term, unless another systematic basis is more appropriate. Now we move on to sale and leaseback transaction. A sale and leaseback transaction involves the sale of an asset and leasing the same asset back. In this situation, a seller becomes a lessee and a buyer becomes a lessor. Accounting treatment of sale and leaseback transaction depends on whether the transfer of an asset is a sale under IFRS 15, that is revenue from contracts with customer. And for this, you can check out my previous video on IFRS 15. So over here, if a transfer is a sale, then the seller accounts for right of use of asset at the proportion of the previous carrying amount related to the right of use retained. Gain or loss is recognized only to the extent related to rights transferred. And in this case, the buyer accounts for a purchase of an asset under applicable standards and for the lease under IFRS 16. However, if a transfer is not a sale, then the seller keeps recognizing the transferred asset and accounts for the cash received as for a financial liability under IFRS 9, which talks about financial instruments. And the buyer recognizes a financial asset under IFRS 9 amounting to the cash paid. So finally, I would really like to briefly touch upon the most important piece of this entire presentation, and that is the impact of COVID on lease transactions. And for this, in May 20, IASB issued amendment of IFRS 16 to tackle exactly the rent concessions provided to lessee as a response to the COVID-19 pandemics. So, if the lessor decreased or forgave the lease payments, then you simply treat them as a variable lease payments not included in the measurement of the lease liability. That is, in the straight away taking it into a P&L with corresponding decrease in lease liability. However, if the lessor decreased the payment in one period but then proportionately increased it in the subsequent period, then you simply need to continue recognizing the lease liability reduction and interest as before. So with this, we come to the end of a very short summary of IFRS 16. Hope you have enjoyed this video. Stay tuned for more such videos. Till then, keep learning, keep inspiring, keep following, keep commenting, keep tagging, keep sharing. Stay lean, stay fit. Peace, India.